The sudden downturn, something is unraveling in South Florida, and it's happening faster than anyone expected. For years, the region was the poster child for sun-soaked prosperity. Home values soared, new residents poured in, and the skyline seemed to change overnight. But beneath the palm trees and endless summer, a financial storm has been brewing, and now it's breaking wide open. The numbers are staggering. More than 275,000 people are projected to leave Florida 25, a mass exodus not seen since the darkest days of the 2008 crash. This isn't just a rumor whispered among anxious homeowners. It's a crisis in motion, with entire communities caught in the crossfire. What's driving this sudden reversal? It's not just one thing, but a perfect storm of skyrocketing insurance premiums, plummeting home values, and mortgage payments that have doubled in just 3 years. In some neighborhoods, families who once felt secure are now facing annual insurance bills that rival their mortgage payments, sometimes reaching a jaw-dropping $12 in a year. Sellers are slashing prices by as much as $75,000 just to get a single offer, while inventory piles up and for sale signs linger for months. The dream of easy money and endless appreciation has vanished, replaced by a new reality where carrying costs outpace incomes, and the math simply doesn't add up. But the real shock isn't just in the numbers, it's in the speed and scale of the unraveling. Miami-Dade alone is set to lose over 67,000 residents, while Broward and Palm Beach counties are bracing for a combined loss of more than 33,000 people. These aren't just statistics revealed, they represent families uprooting their lives, retirees cashing out, and entire neighborhoods facing a wave of forced sales. The population boom that once fueled Florida's meteoric rise has slammed into reverse, and the ripple effects are being felt in every corner of the market. Behind the headlines, the mood has shifted from optimism to anxiety. Real estate agents who once fielded multiple offers in a single weekend now struggle to get buyers through the door. Investors who bet big on short-term rentals are watching their returns evaporate, while longtime residents face impossible choices. Pay the bills or pack up and leave. The sense of security that defined South Florida living has been replaced by uncertainty. As families wonder how deep the slide will go and whether their communities can weather the storm. And yet, the most pressing question remains unanswered. Which cities are getting hit the hardest? And what's truly igniting this statewide exodus? The answers reveal far more than just a market correction. They expose the hidden vulnerabilities that have been building for years, now brought to the surface by a cascade of financial pressures. As the crisis deepens, one thing is clear. South Florida's housing market is no longer the safe haven it once was, and the story of its sudden downturn is only just beginning. But what's really driving people to leave, and how did the dream turn into a nightmare almost overnight? The next chapter uncovers the wallet-driven forces pushing families out and reshaping the future of Florida's most iconic cities. The exodus. Why people are fleeing, the numbers don't lie. Florida's population boom has slammed into reverse. And the reasons behind this mass departure are as dramatic as they are personal. For years, the Sunshine State was a magnet for newcomers chasing affordable homes, low taxes, and a lifestyle that promised endless summer. But now, the very factors that once drew people in are pushing them out at record speed. The exodus isn't just a headline, it's a daily reality for families, retirees, and first-time buyers who suddenly find themselves priced out, squeezed dry, or simply unable to keep up with the relentless surge in costs. At the heart of this migration crisis is a brutal financial squeeze. During the pandemic, home prices in cities like Cape Coral and Naples soared by as much as 80%, creating a feeding frenzy that left buyers scrambling and sellers celebrating. But that celebration was short-lived. As the dust settled, the true cost of homeownership in Florida began to reveal itself. Median home prices are now sliding by $40,000 or $70,000 from their peaks, and the statewide median has dropped to $412,734, a 4% decline year over year, the steepest since 2011. For anyone who bought at the top, the dream of building equity has turned into a nightmare of shrinking values and mounting debt. But falling prices are only part of the story. The real gut punch comes from the monthly bills that just won't stop climbing. The mortgage payments have doubled in just 3 years. A $350,000 loan that once cost $1,475 a month at a 3% interest rate now runs over $2,300 at 7%. That extra $825 a month is more than just a number. It's the difference between staying afloat and sinking fast. For first-time buyers, the math simply doesn't work anymore. For older homeowners on fixed incomes, the hit is even harder. Every month, more and more Floridians are forced to make impossible choices, dip into savings, take on extra work, or put their homes on the market and hope for the best. And then there's the insurance crisis, a financial shockwave that's rippling through every zip code. Property insurance premiums have exploded, averaging $3.23 a year statewide, a staggering 34% jump in just 12 months. In coastal cities, annual bills routinely top $8,000 field, and some policies are clocking in at $12,000 or more. For a typical home in Fort Lauderdale, insurance alone can now rival the mortgage. The result? Families who once felt secure are now living on the edge, watching their budgets get squeezed from every direction. It's not just homeowners feeling the pain. Renters are getting hit too, as landlords pass along higher insurance and tax costs. In cities like Palm Bay, average rents have fallen 20% in a year. But vacancy rates are rising, and the once booming rental market is starting to crack. Investors who once snapped up properties for short-term rentals are now racing to unload them, often at steep losses, as the math no longer adds up. The financial pressure is relentless, and it's forcing people to make tough decisions. Some are cashing out while they still can, hoping to salvage their savings before prices fall further. Others are leaving behind communities they've called home for decades, driven out by bills that keep climbing and incomes that just can't keep pace. The state's affordability ranking has plunged to 49th out of 50, and with wages lagging far behind housing costs, the exodus is only accelerating. But the story doesn't end with those who leave. Every family that packs up and moves out leaves behind a ripple effect: empty homes, declining values, and neighborhoods struggling to hold on. The question now is, how deep will this exodus cut, and what happens to the cities left behind? The next chapter reveals just how far prices have fallen, and why the dream of homeownership in South Florida is slipping further out of reach for so many. The price plunge. If you thought Florida's housing market was immune to a crash, the latest numbers tell a very different story. The price plunge sweeping through South Florida isn't just a correction. It's a full-blown reversal that's catching homeowners, investors, and even seasoned real estate agents off guard. In cities that once saw bidding wars and record-breaking sales, the mood has shifted to panic as home values tumble at a pace not seen in over a decade. The question on everyone's mind: how low can prices go? Who will be left holding the bag? The scale of the drop is staggering. In pandemic hotspots like Cape Coral and Naples, fallen by 40,000 to 75,000 from their peaks. Statewide, the median price now sits at a $412,734, marking a 4% year-over-year decline, the sharpest since 2011. But in some neighborhoods, the cuts are even deeper. Sellers who once dreamed of cashing in big are now slashing their asking prices just to get a single offer. In Cape Coral alone, more than half of all listings have seen at least one price reduction, and some desperate owners are offering to pay closing costs or throw in cash incentives just to lure buyers through the door. Behind these numbers is a wave of financial pain that's rippling through every layer of the market. For first-time buyers, the dream of homeownership has never felt further away. Mortgage rates have more than doubled since 2021, turning what was once an affordable monthly payment into a crushing burden. A $350,000 loan that cost $1,475 a month at 3% now demands over $2,300 at 7%. That extra $825 a month is enough to push many would-be buyers out of the market entirely, leaving homes to sit unsold and inventory to pile up. For those who bought at the top, the situation is even more dire. Homeowners who stretched their budgets to secure a piece of the Florida dream are now watching their equity evaporate. Nearly 8% of Cape Coral homeowners are underwater, owing more on their mortgages than their homes are worth, the highest rate in the country. The fear of falling further behind is driving a surge in listings, as families rush to sell before prices drop even more. But with inventory flooding the market and buyers growing scarce, many are discovering that the only way out is to accept a loss. Retirees and fixed-income households are feeling the squeeze too. As property values fall, the safety net of home equity that many counted on for retirement is shrinking fast. For some, the only option is to cash out and move on, even if it means taking a hit. The rapid decline in prices is also fueling a wave of investor exits. Those who bought properties for short-term rentals or quick flips are now facing a harsh reality. Rental yields have collapsed, and the once booming Airbnb market has cratered. In cities like Punta Gorda and Cape Coral, properties that fetched $675,000 at the peak are now struggling to sell for $500,000. Some investors are slashing prices by $100,000 or more just to escape mounting expenses and vanishing returns. The price plunge isn't just a story of numbers, it's a story of shifting psychology. The fear of missing out that once drove buyers to overbid has been replaced by a fear of catching a falling knife. Veiled. Real estate agents report a sharp uptick in canceled contracts and buyers demanding steep discounts or walking away entirely. The old rules no longer apply, and the market is being rewritten in real time. But the most unsettling part, no one knows where the bottom is. With inventory still rising, mortgage rates hovering near multi-year highs, and insurance costs spiraling out of control, the downward pressure on prices shows no sign of letting up. For many, the only certainty is uncertainty. The Florida housing market, once a symbol of unstoppable growth, is now a cautionary tale of how quickly fortunes can change. And yet, the price plunge is just one piece of a much larger puzzle. The next chapter reveals the hidden force that's making the crisis even worse. An insurance catastrophe that's driving costs through the roof and pushing even more families to the brink. The insurance catastrophe. If there's one force turning Florida's housing crisis from bad to catastrophic, it's the insurance meltdown. For decades, property insurance was just another line item on the budget, a necessary cost but rarely a deal breaker. Now, it's the single biggest threat to homeownership in South Florida, and it's pushing thousands of families to the edge. The numbers are jaw-dropping. Average annual premiums have exploded to $3.23 statewide, a 34% jump in just 1 year. But that's only the beginning. In coastal cities, insurance bills of $8,000, $10,000 or even $12 a year are becoming the new normal. Some homeowners in Miami-Dade are staring down premiums that top $15,000, more than many people pay for their mortgage. How did it get this bad, this fast? The answer is a perfect storm of risk regulation and retreat. In 2022 alone, 6 major insurance carriers went insolvent, leaving hundreds of thousands of homeowners scrambling for coverage. The private market shrank almost overnight. Veal and the state-backed Citizens Property Insurance Corporation ballooned to become Florida's largest insurer, now holding over 800,000 policies. But Citizens was never meant to be the safety net for so many. As more companies pull out, the burden on Citizens grows, and so do the risks for everyone left behind. The crisis isn't just about higher premiums, it's about unpredictability and fear. Every renewal notice brings anxiety. Will the policy be canceled? Will the rate double? For many, the answer is yes. Annual increases of 18% or more are becoming routine, and there's no end in sight. Homeowners who once budgeted for steady, manageable costs are now facing wild swings that can wreck even the most careful financial plans. And if you live near the coast or in a flood-prone area, the situation is even more dire. New FEMA flood maps have reclassified tens of thousands of homes as high risk, instantly forcing families to buy expensive flood insurance or face the threat of lender-imposed coverage at sky-high rates. The impact is immediate and brutal. In Miramar and Pembroke Pines, more than 47,000 homes have been hit with new flood insurance bills, often running $500 to $3,000 a year on top of everything else. For many, the math simply doesn't work anymore. Carrying costs have hit a tipping point, and the state's affordability ranking has plunged to 49th out of 50. Even longtime residents who never saw water reach their driveways are now being told their homes sit in special flood hazard areas, with no choice but to pay up or risk losing their coverage and their homes. The insurance catastrophe is also reshaping the market in ways that go far beyond individual families. Sellers are finding that sky-high premiums scare off buyers, who either demand steep discounts or walk away entirely. Real estate agents report that deals are falling apart at the last minute, not because of price, but because of insurance sticker shock. In some cases, sellers are offering to pay a year's worth of premiums just to get a contract signed. The old model, where insurance was a minor afterthought, has been replaced by a new reality where it can make or break a sale. Investors are feeling the pain, too, revealed. The collapse of the short-term rental market in places like Cape Coral and Punta Gorda is being driven in part by insurance costs that eat up any potential profit. Properties that once seemed like gold mines are now financial traps, with owners slashing prices by $100 or more just to escape the mounting expenses. The investor pullback is accelerating the downturn, removing a key support that once propped up prices and kept the market moving. Revealed. But perhaps the most unsettling part of the insurance catastrophe is that it's not just a Florida problem anymore. As climate risks rise and insurers reassess their exposure, other Sunbelt states are starting to see similar warning signs. For now, though, South Florida remains ground zero, a place where the cost of protection has become the cost of crisis, revealed, and where every renewal notice is a reminder that the rules of homeownership have changed forever. And yet, as devastating as the insurance meltdown is, it's only one piece of the puzzle. The next chapter reveals how the investor exodus is accelerating the unraveling, leaving even more uncertainty in its wake. The investor pullback. If there's one group that can change the fate of a housing market almost overnight, it's the investors. For years, South Florida was their playground, an endless stream of cash buyers, institutional funds, and short-term rental entrepreneurs all chasing the promise of easy returns. But now, the tide has turned, and the investor pullback is accelerating the unraveling of the region's real estate. The numbers are stark. Institutional buyers, who once made up over a quarter of all sales in Florida's hottest zip codes, have now retreated to less than 6%. The safety net that once propped up prices and kept the market humming has all but vanished, leaving a vacuum that's pulling values down even faster. What's behind this sudden retreat? It's a perfect storm of shrinking profits, rising risks, and vanishing demand. Rental yields, once the backbone of investor confidence, have collapsed in cities like Palm Bay and Punta Gorda. In just a year, average rents in Palm Bay have dropped 20%, while vacancy rates keep climbing. The math that once made sense for landlords and Airbnb hosts has flipped upside down. Properties bought at the peak for short-term rental conversion are now being unloaded at staggering losses, sometimes $100 or more below their purchase price, just to escape mounting expenses and negative cash flow. The collapse of the short-term rental market is especially brutal. In places like Cape Coral, homes that fetched $675 at the height of the frenzy are now struggling to sell for $500,000. Investors who once banked on a steady stream of vacationers are now facing a different reality: rising insurance premiums, stricter regulations, and a flood of competing listings. The result: a race to the bottom, with owners slashing prices, offering cash incentives, or even paying buyers closing costs just to get out from under crushing monthly bills. But it's not just the short-term rental crowd feeling the pain. Institutional investors, those big funds and corporate buyers who helped fuel the boom, are pulling back too. Reports claim that their share of purchases has dropped from over 25% to under 6% in just 2 years, with rental yields falling below 4.5% in some markets and the risk of further price declines looming. Many are choosing to sit on the sidelines or dump their holdings before values sink even lower. The days of easy money and quick flips are over, replaced by a new era of caution and retreat. This investor exodus is having a ripple effect across the entire market. With fewer buyers competing for properties, inventory is piling up at a record pace. In Cape Coral alone, over 12,000 homes are now on the market, many of them owned by investors desperate to cut their losses. The glut of listings is forcing sellers to make tough choices: cut prices, offer incentives, or watch their equity disappear. Real estate agents describe a market where every week brings more price reductions and longer days on market, as buyers grow more selective and sellers grow more anxious. The pullback isn't just about numbers, it's about psychology. The fear that once drove investors to buy at any price has flipped to a fear of being left holding the bag. As more and more investors rush for the exits, the downward pressure on prices intensifies, creating a feedback loop that's hard to break. The old playbook, buy, hold, rent, revealed and watch values rise, no longer works in a market where costs are spiraling and demand is evaporating, and the consequences go beyond just falling prices. The investor retreat is stripping away a key pillar of support for the entire housing ecosystem. With fewer rental properties available, some tenants are being squeezed by shrinking options, while others benefit from falling rents. Meanwhile, the loss of investor demand means that sellers, especially those who bought at the top, are facing a harsh new reality. The only way out may be to accept a loss and move on, but the investor pullback is just one force in a perfect storm. As inventory continues to flood the market and sellers scramble to adapt, the next chapter reveals how the sheer volume of unsold homes is reshaping the landscape and pushing South Florida's housing market into uncharted territory. The inventory flood. If there's one image that captures the current state of South Florida's housing market, it's the endless rows of "for sale" signs lining the streets. The inventory flood is real, and it's reshaping the landscape in ways that few could have predicted just a couple of years ago. Active listings have surged by 34% year-over-year, with more than 177,000 homes now sitting on the market, more than double the entire Northeast. In cities like Naples and Cape Coral, the numbers are even more dramatic. Naples has seen inventory jump nearly 34%, while Cape Coral is drowning in over 12,000 unsold homes. A staggering figure that would have been unthinkable during the pandemic boom. What's driving this tidal wave of inventory? It's a perfect storm of rising costs, falling demand, and a growing sense of urgency among sellers. As mortgage rates have doubled and insurance premiums have soared, the pool of qualified buyers has shrunk dramatically. Many families who might have stretched to buy a home just a few years ago are now sitting on the sidelines, watching prices fall and waiting for a better deal. Meanwhile, those who bought at the top are facing a harsh new reality. The only way to attract buyers is to cut prices, offer cash incentives, or even pay closing costs out of pocket. In some neighborhoods, price reductions of $40,000 into $75,000 have become standard, and sellers are learning that patience is no longer a virtue, it's a liability. The flood of inventory isn't just about numbers, it's about psychology. Every new listing adds to the sense of oversupply, fueling buyer hesitation and making it even harder for homes to move. Real estate agents report that homes are sitting unsold for months, with some sellers forced to relist multiple times or accept offers far below their expectations. The days of bidding wars and instant sales are long gone, replaced by a market where buyers hold all the cards and sellers are left scrambling to keep up. This glut is hitting every segment of the market, from single-family homes to condos and new construction. Builders who once couldn't keep up with demand are now offering deep discounts, cash incentives, and even temporary mortgage rate buy-downs just to move inventory. In Palm Bay, over 200 new builds are sitting empty, and developers are slashing prices by $40,000 or more to compete with resales. The same story is playing out in Northport, where rapid growth outpaced infrastructure, leaving many developments with limited services and rising costs. As inventory keeps climbing, the pressure on prices only intensifies, creating a feedback loop that's hard to break. But the inventory flood isn't just a local phenomenon. It's a warning sign for the entire Sunbelt. As similar trends begin to emerge in Texas, Arizona, and beyond, the ripple effects are spreading fast, with inventory to sales ratio stretching to 9 to 12 months in some markets and pending sale cancellations hitting double digits. The old rules of real estate, location, 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 are being rewritten as buyers grow more cautious and sellers grow more desperate. For many homeowners, the flood of inventory is more than just a market trend. It's a personal crisis. Those who need to sell quickly, whether due to job changes, family needs, or financial strain, are finding that the market is no longer on their side. The fear of being stuck with an unsellable home is driving even more listings, as owners rush to get ahead of further price drops. And as more homes linger unsold, the sense of urgency only grows, fueling a cycle that's proving hard to stop. Yet, the inventory flood is only one piece of the puzzle. The next chapter reveals how the condo market, once a haven for retirees and investors, is now facing its own reckoning, with special assessments, soaring fees, and new regulations pushing even more owners to the brink. The story of South Florida's housing market is far from over, and the next wave of challenges is already on the horizon. The condo crisis. If you thought single, Family homes were the only casualties in South Florida's housing unraveling. Think again. The condo market, once a safe haven for retirees, snowbirds, and investors seeking steady returns, has become ground zero for a new kind of financial shock. Behind the glossy towers and ocean views, a crisis is unfolding that's catching thousands of owners off guard and sending shockwaves through entire communities. The numbers are impossible to ignore. In Pompano Beach, median condo prices have slid nearly 8% since the start of 2024, with the average sale now closing at $282,000, down from $370 just 18 months earlier, revealed. But the real story isn't just about falling prices. It's about the hidden costs and sudden bills that are turning condo ownership into a high-stakes gamble. The root of the crisis lies in a perfect storm of new regulations, aging buildings, and skyrocketing expenses. After the tragic Surfside collapse, Florida lawmakers rushed to pass Senate Bill 4D, mandating stricter inspections, reserve studies, and structural repairs for older condos. The result? Special assessments and monthly HOA fees have ballooned to levels that many owners simply can't afford. In some older towers, residents are facing assessments of $20,000 to $80,000 per unit, often due within a year, while monthly dues have climbed to $650 or more. For retirees on fixed incomes, these numbers are devastating. Listings have surged 44% year over year, and condos that once sold in days now linger for months, with nearly a third of active listings showing at least one price cut. But the pain doesn't stop there. Lenders are tightening their standards, demanding detailed reserve studies and proof of completed repairs before approving mortgages. Veiled buildings flagged as non-warrantable due to insufficient reserves or pending assessments can only be sold to cash buyers, shrinking the pool of potential buyers even further. Insurance premiums, already among the highest in the state, are now paired with mandatory reserve contributions, pushing total carrying costs above $100–300 per month for many two-bedroom units. Sellers are offering to pay a year's worth of HOA dues or cover upcoming assessments just to get contracts signed, but even these incentives aren't always enough. The crisis is spreading up and down the coast. In Fort Lauderdale, the median condo now sits on the market for 93 days, more than double the time from a year ago. Sales volume has dropped 21% since last summer, and buyers are demanding full disclosure of upcoming assessments before making an offer. In Port St. Lucie, reserve mandates have forced associations to triple monthly fees in some complexes, and special assessments averaging $12,000 to $30,000 are now standard in buildings over 30 years old. Condo prices have dropped 7.3% year over year, and sales volume is down by almost a quarter. Inventory has doubled, and the number of canceled contracts has spiked as buyers back out after reviewing association budgets. West Palm Beach is seeing a wave of older high-rises hit the market as owners try to exit before the next round of assessments. The average special assessment for buildings subject to new reserve studies now sits at $38,000 per unit, with some luxury towers demanding six-figure lump sums. Median condo prices have fallen 6.2% since last spring, and active listings are up 54%. Units in buildings with completed reserve studies command a premium, revealed, while those facing uncertain repairs are being discounted by 10% or more. Buyers are more cautious than ever, often walking away if the numbers don't add up. Even St. Petersburg, once a magnet for out-of-state investors, is experiencing its sharpest downturn in a decade. Sales have dropped 23% year over year, and more than a third of listings have been reduced in price at least once. Associations are under pressure to complete milestone inspections and set aside reserves for major repairs, leading to sudden fee increases and special assessments ranging from $15,000 to $60,000 per unit. Insurance costs, already on the rise, are compounded by new flood zone designations along the bayfront. For many owners, the combined burden of insurance, reserves, and assessments now exceeds their mortgage payment. The old model of low fees and deferred maintenance is gone. Reserve mandates, special assessments, and insurance hikes have reset the economics of condo ownership. Units in buildings with clean bills of health and full reserves are holding value, but the rest are facing a slow-motion reckoning. For thousands of owners, the true cost of living by the water is only now coming into focus. And as the condo crisis deepens, the next chapter reveals how sudden policy changes, like FEMA's flood map revisions, are adding even more pressure, reshaping the very definition of homeownership in South Florida. The policy shock. Just when South Florida homeowners thought they'd seen the worst, a new wave of policy changes has sent shockwaves through the market, upending the rules of the game almost overnight. The most dramatic of these, FEMA's revised flood maps, which took effect across Broward County on July 31, 2024. In a single stroke, nearly 89,000 properties were reclassified as high risk, instantly forcing thousands of families into mandatory flood insurance zones. For many, the news arrived not as a warning but as a bill, one that could add $200,000 to $3,000 a year, or even more, to their already stretched budgets. The impact was immediate and brutal, especially for those with federally backed mortgages, who had just 30 days to secure coverage or face lender-imposed policies at sky-high rates. The numbers are staggering. In Miramar alone, the 25,878 properties were swept into the new flood risk category overnight. Pembroke Pines saw 22,079 homes reclassified, while Hollywood added another 7,392. Even smaller cities like Dania Beach and Tamarack weren't spared, with thousands of parcels suddenly facing new financial burdens. For longtime residents, many of whom had never seen water reach their driveways, the shift felt surreal. Suddenly, homes that had been considered safe for decades were now labeled as high risk, and the cost of compliance was anything but optional. But the policy shock didn't stop at flood insurance. City officials, aware of the financial strain, urged residents to keep their policies, even if they were technically removed from mandatory coverage, citing the unpredictable nature of Florida's storms, revealed. Hollywood's participation in the National Flood Insurance Program's community rating system offered a 20% discount, but for most families, that was little comfort in the face of soaring premiums and new assessments. In Dania Beach, with its smaller footprint, the reclassification hit especially hard, piling new costs onto homeowners already grappling with rising property insurance and storm vulnerability. Even Tamarack, which had achieved a Class 6 rating for a 20% premium discount, found itself on edge, as prior map changes and the threat of further revisions kept residents anxious about the future. The ripple effects of these policy changes are everywhere. Real estate agents report a sharp uptick in price reductions and longer days on market as buyers factor in the new insurance costs and demand steep discounts. Sellers who try to pass along the cost of new flood policies are finding fewer takers, while buyers are more likely to walk away entirely if the numbers don't add up. The suburban dream, once defined by predictable costs and steady appreciation, now comes with a warning label. And the flood zone squeeze is just beginning to reshape how these neighborhoods value risk, affordability, and the true cost of home ownership. But flood maps aren't the only policy shock shaking the market. New state laws around condo reserves and structural inspections have added another layer of uncertainty, especially for owners in older buildings. Special assessments, mandatory reserve contributions, and stricter lending standards are all converging at once, creating a perfect storm of financial pressure, revealed. For many, the combined effect of these policy changes is overwhelming, forcing impossible choices between paying the bills, selling at a loss, revealed, or leaving the state altogether. What's most unsettling is the speed at which these changes have taken hold. In just a matter of months, entire communities have been forced to rethink their budgets, their risk tolerance, and even their long-term plans. The sense of stability that once defined South Florida living has been replaced by a new reality, one where policy decisions made in distant offices can reshape the value of a home overnight. And yet, the story is far from over. As more legislative reforms are debated and new regulations loom on the horizon, revealed, homeowners and investors alike are left wondering what the next policy shock will bring. The only certainty is uncertainty, and the need for vigilance has never been greater. The next chapter reveals how these local shocks are now rippling across the Sun Belt, revealed, with other states beginning to feel the aftershocks of Florida's housing upheaval. The ripple effect, beyond Florida. What started as a uniquely Floridian crisis is now sending shockwaves far beyond the state's borders. The unraveling of South Florida's housing market has become a cautionary tale for the entire Sun Belt, with warning signs flashing in places that once seemed immune to such turmoil, as the headlines about Florida's mass exodus, plunging home values, and insurance catastrophes spread. Buyers, sellers, and investors across the country are taking notice, and the ripple effect is already reshaping markets from Texas to Arizona and beyond. Texas, long celebrated for its booming cities and affordable living, is now showing the same early symptoms that swept through Florida just months ago. In Austin, active listings have jumped 13% in the past year, while Dallas-Fort Worth inventory has soared by 31%. Houston and San Antonio aren't far behind, with inventory up 24% and 16% respectively across the state. The total number of homes for sale reached 123,000 in April, 53% higher than the typical average and the highest level in over a decade. Price cuts are spreading fast, with 34% of Dallas listings reduced and over 30% in Austin and San Antonio seeing at least one price drop. Statewide, nearly 28% of all homes on the market saw a price reduction in April alone. The message is clear: the days of sellers calling all the shots are over. And buyers are gaining leverage in ways not seen since the last major downturn. Arizona's housing market is cooling even faster. In Greater Phoenix, home prices have dropped 6.9% from their 2022 peak, and the average home now sits on the market for 79 days. Active listings in Phoenix climbed past 25,000 in July, a 36% year-over-year surge. New listings are down, but homes are lingering unsold, echoing the inventory buildup that's become all too familiar in Florida. Across the Sunbelt, inventory to sales ratios have stretched to 9 to 12 months, and pending sale cancellations are up to 15%. In cities like San Antonio, Memphis, and Jacksonville, buyer activity has dropped by double digits, according to Zillow's Market Heat Index. With mortgage rates hovering near 7%, buyers are no longer rushing to lock in deals. They're negotiating hard, demanding concessions, and walking away if the numbers don't add up. The ripple effect isn't just about numbers. It's about psychology. As news of Florida's unraveling spreads, buyers in other states are growing more cautious, scrutinizing every detail and refusing to overpay. Sellers, once confident that demand would always outstrip supply, are now facing a new reality. Homes can sit unsold for months, and price cuts are often the only way to attract attention. Investors, too, are rethinking their strategies, wary of getting caught in the same downward spiral that's gripped South Florida. Reports claim that institutional buyers are pulling back in multiple Sunbelt markets, and the days of easy profits from short-term rentals or quick flips are fading fast. But the most striking part of this ripple effect is how quickly it's spreading. The same forces that triggered Florida's crisis, rising insurance costs, surging inventory, and affordability pressures, are now converging in other hot markets. In some Texas cities, foreclosure rates are climbing, and distressed sales are starting to feed a negative cycle of falling values and rising defaults. In Arizona, the once frenzied pace of sales has slowed to a crawl, and buyers are demanding full transparency on everything from HOA fees to special assessments before making an offer. For buyers across the Sunbelt, revealed, the shift means more leverage and more options, but also more risk. Lower sticker prices are only part of the equation. Carrying costs, insurance, taxes, and association fees can easily add hundreds or even thousands to the monthly bill. The lesson from Florida is clear: due diligence is no longer optional, it's survival. Every deal demands sharper scrutiny, and the smartest buyers are building checklists, confirming all monthly costs, and negotiating every possible concession before signing on the dotted line. As the ripple effect continues to spread, one thing is certain: the story that began in South Florida is now a warning for the entire country. The next chapter reveals what buyers and investors need to know to navigate this new landscape, and why careful research and relentless vigilance are more important than ever. What buyers and investors need to know. In a market where the rules seem to change overnight, buyers and investors in South Florida and across the Sunbelt are facing a landscape that demands more caution, more research, and more strategy than ever before. The days of easy money, quick flips, and bidding wars are gone. Now every decision comes with higher stakes, and the margin for error has all but disappeared. So what do you need to know before making your next move? First, understand that sticker price is just the beginning. The true cost of homeownership in 2025 is a complex puzzle, with carrying costs that can easily rival or even exceed your mortgage payment. Insurance premiums, property taxes, flood coverage, and homeowners association fees can add anywhere from $800 to $500 a month on top of your principal and interest. In some cases, Especially for condos or homes in newly reclassified flood zones, these extra costs can be the difference between a smart investment and a financial trap. For older buyers or those on fixed incomes, it's essential to request a full breakdown of all ownership costs before making an offer. Don't just ask about the mortgage, demand to see association budgets, reserve studies, and documentation of upcoming repairs or special assessments. Next, veiled. Due diligence isn't just a buzzword, it's your lifeline. In today's market, every buyer should build a checklist and stick to it. Scrutinize reserves and assessments in condo buildings, verify the exact flood zone for any property, and get quotes for both property and flood insurance before you sign anything. Premiums can vary by thousands of dollars, even within the same zip code, and a surprise bill can turn a dream home into a nightmare. If you're considering a condo, review the association's financials, ask about upcoming repairs, revealed, and make sure the building isn't flagged as non-warrantable. Otherwise, you could be stuck paying cash or facing higher interest rates. For investors, the game has changed. The days of relying on rising rents and endless appreciation are over. Run updated cash flow models that factor in higher vacancy rates, falling rents, and rising insurance costs. Leverage can be a double-edged sword. While price drops may create entry points, negative cash flow can wipe out gains if the downturn drags on. Be realistic about your holding period and exit strategy. If you're buying for short-term rental income, check local regulations and be prepared for increased competition and lower yields. The investor pullback in Florida has shown just how quickly the math can flip and how fast a hot market can turn cold. Negotiation is now a buyer's best friend, revealed. With inventory at record highs and homes lingering unsold for months, sellers are more willing than ever to offer concessions. Don't be afraid to ask for seller paid rate buy downs, closing cost credits, or even a year of homeowners association dues. In some cases, you can negotiate for repairs, upgrades, or cash incentives just to get the deal done. But remember, lower prices and incentives are only part of the equation. Make sure the numbers work long after the closing table, and don't let a flashy discount blind you to hidden costs. Finally, stay vigilant. The market is still shifting, and new policy changes, insurance rules, or economic shocks could reshape the landscape again in a matter of months. Keep an eye on legislative reforms, local regulations, and insurance company moves. What's true today might not be true tomorrow, revealed, and the smartest buyers and investors are those who adapt quickly and never stop asking questions. In this new era, survival isn't about finding the lowest price. It's about making sure every piece of the puzzle fits. The evidence from South Florida's unraveling is clear. Careful research, relentless due diligence, and a willingness to walk away are your best tools. The next chapter in this story belongs to those who are prepared, informed, and ready to navigate a market where the only constant is change.